Are you 65 or older? Then I've got some good news for you. The new One Big Beautiful Bill just created a brand new senior tax deduction starting in 2025, which could bring you some big, beautiful tax savings. Today, I'll go deep into the tax planning software I used to show you how the new deduction works, how much the new tax bill might save you in taxes, and how this new phase out of the senior bonus deduction starts to erode your tax savings. Now, here's a slight change that helps everyone. In 2025, that standard deduction is going up for everyone that uses the standard deduction. That's $750 more of a standard deduction per person, so for single or for joint. But this is new here. If you're 65 or older, you get this additional bonus extra deduction. There's really no name for it, so everyone's calling it the senior bonus deduction. Now, this bonus deduction is temporary. It's not permanent. So we'll want to see how this breaks down. It's only for 2025, 26, 27, and 28. So if you're single and you're 65 or older and you use that standard deduction, that's $15,750 for the standard deduction. You get $2,000 more already for being 65 or older. So that's $17,750 for your standard deduction on your tax return. Now, if you itemize, it could be higher. Whether you are standard or itemized, you still get that new $6,000 senior bonus deduction. So if you are a standard deduction person, this year, that's $6,750 more in deductions than you would have received otherwise in 2025 from the old tax law. If you're married filing jointly, you're both over 65. That standard deduction went up by $750 for both of you. Now it's $31,500. You still get the same $3,200 extra standard deduction for being 65 anyways. And if you're both 65, that's a combination senior bonus deduction of $12,000. So that's $13,500 more in deductions this year in 2025 because of the new tax law, which if you're doing the math, that's $6,750 per person in extra deductions, same if you're single. So I'm going to dive into the software and compare how the new law affects your taxes this year compared to the old law. So here's the tax planning software I use with my clients as they're planning out and projecting what the tax year might look like. I've got the old tax law for married and the old tax law for single compared to a retiree for this year if they're single or married. Looking at the married columns here on the left, this example, we've got Mike and Lisa retiree to show you. They bring in $50,000 per year from their IRA, $50,000 per year from their pension, and $50,000 per year from Social Security, which is never 100% taxable. For them, 85% of that is taxable. So their income's $150,000, but their total income for tax purposes is $142,000. That's before all these deductions that we are looking at. Now they're in the standard deduction area, which would have been $33,200 previous law. The new law is now $1,500 extra additional, rather at $34,700. Here's why that extra comes in, being both 65 plus, that's $12,000 of extra deductions. So you've got $150,000 of income. It's already a little lower because of Social Security. Then you take out the standard deductions, which are more now. You take out the new senior bonus deductions. And instead of $109,300 of taxable income for Mike and Lisa, we've got $95,800. Lower income generally means lower taxes. So let's take a look here. The taxes now for Mike and Lisa are $11,000 compared to almost $13,900. So that's over $2,800 of tax savings. They didn't do a thing different. That's just from the tax law. Part of that is from the lower taxable income with the extra deductions, but that lower taxable income brought them down in their tax bracket. They were in the 22% tax bracket with the law the way it was written before the One Big Beautiful Bill came around, and now they're in the 12% tax bracket for that marginal tax bracket. Let's see how it looks for a single retiree. So I just took the single retiree, cut everything in half with the income, And we've got single under the old law on this column and single under the new law in the third column. Now, the couple here, Mike or Lisa, doesn't matter which one, would be bringing in $25,000 from their IRA, $25,000 from their pension, $25,000 from their Social Security. Now, only 85% of that is taxable at the max. So that's $21,250, bringing in $75,000 of income, but the total income, the AGI that shows up for them is $71,250. Now you can see here where the standard deductions are $750 higher, and the new senior bonus deduction of $6,000, that brings the taxable income down to $47,500 compared to $54,250. That is the $6,750 lower income because of the $6,750 higher deductions. Well, how did that show up for income? Under $5,500 for the total taxes compared to over $6,800 for the total taxes. Same tax year, just the fact that we're in a new law, that's a tax savings of almost $1,400 for the single retiree. Part of it's from the extra deductions, just like the married couple. Part of it's from no longer being in the 22% tax bracket at the beginning of that bracket, but having the top of their income coming in at the 12% tax bracket. Now, this is the type of tax planning we do as part of our retirement master plan process at Keil Financial Partners. If you'd like to see if our retirement planning financial process is right for you, head on over to keilfp.com, keilfp.com. We'll talk to you soon. Now, not everyone gets this full benefit. I talked about the phase out. The extra deduction starts phasing out if your modified adjusted gross income is over $75,000 when you're single, or over $150,000 when you're married filing jointly. It's completely gone when your income is $100,000 more than those amounts. So the phase out is done. You've completely lost the senior bonus deduction if you're single and your income is above $175,000, or if you're married filing jointly and it's above $250,000. Let's see exactly how it affects you, especially with something called the marginal tax cost. Now we've got Mike and Lisa here, and this is what we call the tax map. It takes a look here, the $0 that's way down on the bottom. That's saying this is your steady state. The dark line is a steady state. And what does life look like as you're adding on extra income? I mentioned the new tax law. We're looking at the new tax bill right now. Brought their income down so that their top part of the income was no longer 22% tax bracket, but in the top of the 12% tax bracket. So as we add on extra income, how does that extra income cause additional taxes and loss of deductions, which causes additional taxes? So notice that very quickly, because I mentioned they're at the top of the 12% tax bracket, that additional income becomes the 22% tax rate. Then they get to that level where they are adding income on. Perhaps they've taken money out for a vacation, new windows, new car, whatever it is. As they add on the extra income, the natural thought is, well, what's my tax break? 22%. I took out 10 grand, 50 grand, whatever it is. I owe 22% on that. But in the world of the senior bonus deduction, with that phase out, you're also losing deductions, which creates additional income, additional income taxes. So you might be in the 22% tax bracket, but then the cost of extra income is a loss of the deduction. That 22% very quickly for a married couple becomes a 24.6% tax, which is interesting because that's higher than when you go down the line and you're in the 24% tax bracket. So a lot of people are worried, I don't want to go to the next tax bracket. Here's somebody that is in the lower 22% tax bracket, perhaps. Then when they go up down the road to the higher tax bracket, their marginal cost actually goes down. You'll see a dotted line here too, because when you're 65 plus, you're very likely on Medicare. When you are planning out what is the extra cost for taking money out, you don't want to only think of the tax bracket. You want to think of what is my tax cost. We're seeing here the green is the tax cost from the phase out of the senior bonus deduction. Hopping over the dotted line is the added tax cost from Medicare costing you more, over time. That's why when you take a look at your tax planning, you can't just look at the tax brackets. I like this display here where it's a tax map showing as you go along, what does my added income turn into in terms of added cost? What is my marginal tax rate? It's very similar when you are a single retiree. The difference here is that the added phase out is still the same $100,000. It's spread out over a smaller amount because there's just one of them. It's spread out over a longer period in a way, or the same period, just a lower amount. And so that added cost of losing the deduction is only 1.3%. So you might have just quickly got to the 22% tax bracket. Your marginal cost is now 23.3% as you're losing that phase out. The other thing that happens too, it looks like a benefit almost to the single retiree, is that you much quicker get to the point where the added costs of Medicare are coming in. This added Medicare cost is coming in for him at about $35,000 away. We're talking here about $70,000 away for the married couple. So you much sooner get to the point where you're paying higher costs and Medicare. Another reminder that even though we're talking right now about the senior bonus deduction, you've got to plan out how your taxes look overall, including when you lose deductions through a phase out, and including what happens when you are paying extra for Medicare and a whole variety of different tax things that go into it. You saw how the new senior bonus can help you in your taxes, especially for 2025 compared to the prior law. You saw how the phase out actually gives you a higher marginal rate of taxes than you might have expected. If you're retiring sooner, here's the added planning steps you'll want to look at because of the senior bonus deduction. If you're already in the room of the senior bonus deduction, that just might give you more ability to do Roth conversions at the lower tax rate. If you've got this additional $6,000 bonus, that could be an additional $6,000 of Roth conversion, get more tax-free money into that Roth account for, compared to before, virtually the same cost. It's almost like you might use your tax deduction to perhaps do a little bit more in Roth conversions. The senior bonus might just give you a chance to take more money out of your accounts somewhat tax-free. If you get this added deduction, it goes against your added income, whether it's Social Security or any other income. And of course, this senior bonus is temporary. It only affects this year, 2025 through 2028. So you really need to project out how these tax changes with the One Big Beautiful Bill, the senior tax bonus, and how your own tax changes, like perhaps you hit Social Security age or you start your required minimum distributions, plan those out, project those out so that you can plan to lower your lifetime taxes. Hi, I'm Jeremy Keil. If you'd like to learn how my team can help you get more income, pay less in taxes, and avoid big retirement mistakes, head on over to keilfp.com. That's KEILFP.com.